Hi, I'm Pavli Sabic and I'm a solutions architect in the S&P Capital IQ product and content team, here to bring you the latest solution exchange research. We hear flight to quality and immediately think of Germany, Switzerland or the US, but Scandinavian countries could be another destination according to research conducted by S&P Capital IQ's solution architect team. Let's start with the Denmark National Bank, whose stated public debt to GDP stood at 43.5% at the end of 2011. That's less than half of the EU average. Danish short-term bond yields were negative, possibly due to the krona's currency peg to the euro. Also, Danish 10-year yields dipped below 1% at the start of June, lower than Germany, making Danish bonds in that respect even more of a haven than German bunds. However, sovereign and CDS spreads tell a different story. Denmark has the highest sovereign spread amongst other Scandinavian countries, namely Sweden and Norway, as well as Germany. This could be a market reaction to the high number of Danish bank defaults since 2007 and the housing price drop of 25% since their peak in 2007. Furthermore, Standard & Poor's rating service revised its banking industry country risk assessment, BICRA for short, on the Kingdom of Denmark to Group 3 from Group 2 in November of 2011. To be clear, the lowest risking bank system is Group 1 and the highest is 10. The other countries in BICRA Group 3 include Korea, New Zealand, the UK and the US. And it's exactly this paradox that we explore in the research piece. But would you take a flight to other parts of Scandinavia? Perhaps. Sweden public debt to GDP in 2011 reached 38.4%, lower than Denmark's and substantially lower than Germany's 81.8%. Sweden's CDS spread is also lower than Germany's. Looking at Norway, where unemployment has been falling, GDP is up, and the oil investments is estimated to be rising faster than anticipated to 200 billion NOK in 2013, up 51 billion NOK from a similar forecast in 2012, reported by Danske Markets. However, there is a discrepancy in that Swedish and Norwegian yields are higher than Danish bonds. To sum up, the Danish government should be able to issue securities with negative yields for up to 2 years, and its 10-year government bonds are trading with a lower yield than the equivalent German bonds. Norway and Sweden run a lower budget deficit and government debt levels than Denmark, attracting international interest in their securities, be it with a slightly higher yield. While there are considerable concerns about Danish banks and the ongoing housing crisis, the Danish bond market appears healthy and demand for its bonds appears to be increasing. Sweden and Norway appear to also be attractive destinations. If you want to know the full details of this Scandinavian puzzle, read our recent publication, Solving the Denmark CDS Spread Puzzle on www.spcapitaliq.com.